안녕하세요. 환경 글로벌 마켓의 김현석 뉴욕 특파원입니다. 반갑습니다. 부채한도 인수는 거의 해결이 됐습니다. 그리고 시장은 엔비디아 등 기술주를 중심으로 계속해서 강세를 유지하고 있고요. 그러나 페드는 또다시 금리를 인상할 수도 있습니다. 이런 복잡한 상황에서 우리는 어떻게 해야 될까요? 네드 데이비스 리서치의 에드 클리솔드 미국 주식 수석 전략가를 모셔서 앞으로의 시장 향방에 대해서 들어보겠습니다.
My first question is the debt ceiling problems, debt ceiling issues. Debt ceiling bill passed the House yesterday. And do you think a deal in Washington could a catalyst for a breakout?
I think it would need to be one of a few things that be positive developments for a breakout. Probably a debt ceiling deal by itself won't be enough because most investors expected it to get done at the last minute. That's just the nature of how Washington does business. Both sides have an incentive to go as far as they can to extract as many concessions from the other side as possible. So while it's a sigh of relief that the debt ceiling is looks like it's going to get passed, there probably more needs to be done for the market to really start a new up leg for another big rally.
Mhm. If the debt ceiling is suspended, the Treasury Department is expected to issue more than 1 trillion of Treasury bond, especially the T-bills in the near term. Do you think falling liquidity will have a negative impact on the market? If you think so, and how much will it be?
I don't think it's going to be a major impact, and the reason is that the Fed has been managing this through other parts of its balance sheet, and also investors have been adjusting as well. So when you start to reverse all the things that have happened over the past couple of months as the Treasury Department's had to manage the debt ceiling, the net impact is much smaller than just looking at all the Treasury issuance. For example, money market mutual funds, which are a way a lot of investors in the U.S. put their cash holdings, have avoided buying short-term Treasury bills over concern over the debt ceiling. But they'll be much more willing buyers now, and they may absorb a lot of the issuance. So it's a net negative, but not nearly as negative as maybe some of the headlines imply.
Oh, okay. I understand that. After the debt ceiling issue resolved, where do you think the investors' focus will move on?
I think there's two things. One is what the Federal Reserve is going to do. Are they going to raise rates in June? Are they going to pause? And for how long? And then the other thing is that corporate profits were actually quite strong in the first quarter in the U.S. And is that a sign of better earnings for the second, third, and fourth quarters? Or was that just a case of maybe investors had gotten too pessimistic and analysts had lowered the earnings bar too much? So earnings expectations are higher for the second quarter. So I think that'll be another area of focus for investors.
I will ask you that problems specifically. Fed officials yesterday talked about skipping the hike in June. What are your expectations for the June FOMC?
We do think the Fed is going to not hike in June. So now we start a pause in the Fed tightening cycle. I don't think the Fed is going to commit to cutting rates because the economy still remains in pretty good shape. The unemployment rate is still very low. And for the Federal Reserve, they have two mandates. It's low inflation and full employment. And so as long as the unemployment rate is well below 4%, they can focus almost exclusively on the inflation side of things. And while inflation has come down, it hasn't come down all the way to the 2% target. So I think that they can go on pause, see what the effects of the rate hikes that they have done so far are having on the economy, and also the effects of the regional banking crisis on the economy before they decide if they need to go further or not.
And you have been expecting the moderating trend in inflation to slow in the second half of the year. Do you still think so?
Yes, we do. There were some aspects to the moderating inflation that were kind of one-off effects. So last year, this time inflation was very high. So just the year-to-year comparisons get easier. The supply chains from COVID, while some of those were disrupted for several years, those have largely worked themselves out. So we're not going to get the benefit from that as much in the second half of the year. And then also there's some technical aspects to U.S. inflation with how we account for housing, something called owner's equivalent rent, which is how a lot of our inflation measures take into account the housing market. And that happens with a lag. So when housing got weaker toward the end of last year and early this year, it took a while for that to show up in inflation. But as the housing market is stabilized moving forward, we get to the second half of the year, some of those benefits won't be there as well. So you put all that together, and it means that inflation again is coming down from the peak of last year, but we don't think it's going to keep decelerating as quickly as it has been.
If that case happens, and I guess the Fed need to hike some more, and do you guess how much interest rate, the policy rate, will keep the interest rate to come down to all the way to the 2%? How much more hike?
Yeah, so I think what the Fed will probably do is stay on pause for a few meetings, and then we'll see what the economy is doing. Our macroeconomic team thinks the Fed will just stay, keep rates at the current level for several months. I wouldn't be surprised if they hike maybe one more time, but again, not immediately. This would be
Maybe
later in the
September or
year.
something.
Exactly. Yes. At that point, let's say the inflation rate has come down, but it's still close to 4%. Unemployment is still close to 4%. That the Fed may feel that they have room to raise again without hurting the economy too much. That may be a mistake. We'll have to see. But there might be one or two more hikes to get the inflation rate down. But again, not in the near term. That'd come later on in the year.
Oh, okay. I got it. How do you expect interest rate to move? Will the 10-year Treasury yield rise again above 4% in this year?
I think 4% would probably be pretty high. I wouldn't expect it to get quite to that level. Interest rates have backed up a little bit over the past few weeks. I wouldn't be surprised if maybe over the coming weeks they came back down a little bit. But if the economy does remain fairly strong, I would think long-term rates could back up again. But 4%, to get above 4% would probably mean inflation really accelerating and economic growth accelerating a lot as well. So probably not. I wouldn't say 4% would be our target.
The dollar is strengthened again as fears of further tightening grows. Do you think the dollar will continue to rise?
I think we're probably setting up a trading range for the dollar. Again, as it becomes clear that the Fed is going to be on pause, then some of the recent strength in the dollar may back off a little bit. And of course, currencies are all relative. The U.S. economy is proving to be fairly resilient relative to other economies. So that could keep the dollar from falling below its levels of last year. But overall, we're looking for a pretty broad trading range in the U.S. dollar.
Looking at the JOLT report yesterday and ADP today and claims today, I wonder if the inflation problems won't be solved without a recession. Is a recession necessary?
Yeah, to get to 2%, it might be. Now, and that's the Fed's official target. If inflation gets close to 3%, the Fed may not change their target, but they may acknowledge that is as good as we can get for now. Because in the U.S., there are some demographic challenges with baby boomers retiring. The average boomer in the U.S. is now over 65 years old. And that's putting strain on the rest of the labor market, which is why you've seen pretty strong job reports and any sort of labor statistic, as you mentioned. It's been fairly robust. And so the Fed may be willing to live with inflation slightly above 2%, but if it's closer to, say, 4%, the Fed may feel compelled to tighten again, in which case then they may, in fact, tighten into a recession to get inflation closer to its 2% target. So I think that if you were to look for reasons why the Fed would keep going, you're right, the labor market is the number one reason.
And do you still expect a recession in the fourth quarter or early next year?
I think we're pushing that out a little bit more. I'd say probably 2024 is more likely than 2023, and maybe even you get into the second quarter of next year. So again, the U.S. economy has proven to be fairly resilient. There aren't a lot of recession signs at the moment. So it would take a pretty big shock to the system to get a recession to start this year.
As tech stocks lead the markets, and many said the market breadth is so narrow. But looking at Barron's article yesterday, Professor 애시워스 다모다란 from the New York University, he said market never had a breadth. He recently looked at 80 years of market data and found that the big bull runs were commonly carried by 10% of stocks or less. How do you think so?
Well, yeah. I think it's a very interesting analysis. And if you're looking at a market cap weighted index like the S&P 500 or the NASDAQ composite, the largest companies have the biggest influence. That's how they're created. And so if they're in bull markets, the largest companies are going to have the biggest positive impact. Now, what you want to have, though, is you still want to have most stocks rallying. It's okay if the biggest stocks are rallying more, but what you don't want to have is have everything else not rallying. For example, in the second half of 1998 into 1999, it became only about the internet stocks. Everything else was struggling. And so that's not the kind of environment that you want to see. So over the past 3 months, only 25% of S&P 500 stocks have outperformed. That's actually a record low going all the way back to 1972. So if you look forward, market returns have been fairly weak, up only 2% in the year after you get this kind of narrow breadth. So you want to see more stocks start to participate to think that the rally can continue. But again, it doesn't mean they have to lead. You just need the mega cap stocks to not be the only ones going up.
And the AI boom is really hot. Expectations seem high that the adoption of AI will translate into the higher productivity and improved margins. And do you think the AI enthusiasm could spark a bull market despite the deteriorating macroeconomy?
The AI boom has certainly been a big part of the stock market doing well this year, and because there aren't a lot of what you would call pure AI plays or smaller companies that are publicly traded that do just artificial intelligence. So the way to get exposure is to buy the mega cap names that are also in that area. So that is part of what's been going on over the past several months. From a markets perspective, economically, this could be a productivity game changer to make a lot of companies, a lot of employees more productive. It looks like that the economic realization will take time, and that's happened throughout history where the markets maybe get ahead of the economy and start pricing a lot of great news, and then they have to get more realistic. And so I'm not sure if AI is going to save the economy in 2023 or 2024, but if you want to look out over the next several years, that could be part of a very nice tailwind of productivity growth that allows the economy to do well without causing inflation.
Nvidia stock has risen 160% this year, and semi stocks rose the most by industry in May. Do you think these tech stocks are overbought in near term? What are your thoughts on this AI-related tech stock boom?
Yeah, I think short term they are overbought. If you want, for example, the S&P 500 tech sector is what we call 2 standard deviations overbought. That if you look at its performance versus the market over the past couple of months, it's in the top 5% ever for the tech sector. Now, does that mean they have to go down right away? No, they can stay overbought for a little while, but ultimately, they will probably take a breath, and other sectors will start to outperform for a while. So yeah, they're fairly overbought, but again, that doesn't mean they go down right away.
Is it a bull trap now? We are in 4,200, and it's a high end of that trading range. So we are in the bull trap.
I think the market can actually move above 4,200 this summer. As part of the realization the economy is in pretty good shape, profit growth is maybe better than expected, and so those things will combine to allow the S&P to move higher, maybe towards 4,400, even 4,500. Beyond that, I think you'd have to see confidence that a recession next year is off the table. So I think there is room for another up leg to the market, until the Fed perhaps starts to think about tightening again and then causing a recession. So I think 4,200 level could be broken out, and we could get a nice summer rally.
Economic data for April and May are not too bad. And could the regional bank crisis have passed without much impact?
I think we're going to see some residual effects over the next several months as some of the smaller banks tighten their lending standards, and that will take time to ripple through the economy. But in terms of a systemic shock, that is these bankruptcies from these fairly large companies, we had 3 of the largest bankruptcies in the banking sector ever in the past few months. In terms of that causing a ripple effect through other banks, that risk over the short term has appeared to have passed. That the Treasury Department and the Federal Reserve added enough liquidity and provided enough support for the banks to avoid a broadening bank run. So that's certainly a positive for the economy.
The first quarter earnings season was better than expected. And what is your forecast for the second quarter earnings?
So consensus estimates, so not our numbers, but what the average analyst is looking for, is calling for about 11% earnings growth in the second quarter, versus around 8% in the first quarter. So it may be tough to get to 11%, but we could still get modest
11% YOY, year over year?
Yes.
Oh.
Yes. So 11% is a consensus estimate for second quarter 2023 versus second quarter 2022. Yeah. So if it ends up being, say, 5 to 7% instead of 11%, I think the stock market would digest that okay. If it ended up being close to 0 to 2%, that's a pretty big downward revision, and the market would probably take notice of that. So I think there's room for earnings estimates to come down a little bit before it'd be a big problem for the market.
June has historically been the underwhelming month for stocks. And how do you see the stock market in June and summer? It's up to the 4,500. It's quite strong, I think.
Yeah, and I think that could take us into maybe July, August, September period before we get that high. So yeah, June is one of the weaker periods of the market, so maybe we consolidate a little bit of the gains over the next few weeks, particularly now, as we talked about at the beginning of our conversation, the debt ceiling is largely behind us, and now we have to turn our attention back to the Fed. That maybe the market could pause for the next, in the very near term, before the summer rally gets going, into July, August, September.
I would like to hear your views on Chinese economy and the market. It rose sharply last year, but has fallen sharply this year. Isn't it a time to buy the dip?
So we are not overweight China in our regional allocation. And part of the reason is that the reopening of several economies that remain closed longer during COVID, that's kind of behind us, and manufacturing supply chains are largely not abandoning China, but there's a lot of companies that are diversifying away from China. And so that's going to be a challenge from the Chinese stock market perspective. And also, demographics in China are not as positive as they were in years past. So that's going to hurt consumer spending, and you throw on, a lot of debt in the Chinese economy as well. So it's not an area we would be particularly focused on from an investment perspective over the next 6 to 9 months.
How about the Japanese market? Japan stocks rose sharply. And do you think it can go up further?
So that is actually an area we are overweight in Japan, because a lot of the companies in the Japanese indices are fairly well positioned to take advantage of good economic growth in places like North America, where the economy is growing stronger than other parts of the world. And so that would be an area that we would focus on.
That was my last questions. And thank you for being with us. And I always surprised at how good your answer is. So precise and so insightful.
Oh, well, thank you so much. I really appreciate the opportunity to talk to you.
Thank you very much. And I hope see you soon again.